Good morning, traders and investors. Roger Scott here, Senior Strategist for Wealth Press. It's Friday. It's April 21st. I can't believe it's Friday. It's about 7:07 in the morning. I'm getting this to you nice and early, way before the market opens, because people are asking me to do that. They want to know what's going on with the market nice and early ahead of time. And as you know, Friday I talk about algos. Now, there's a couple of things I want to bring up to you, and that's really important. First of all, algos tend to strike when volume and liquidity is at the lowest level. Why? Well, because they can do the most damage and they can influence the market. If volume and volatility is really high, there's a lot less control they have over the market and they have to work extra hard. So one of the things we've noticed is algos tend to come in Mondays, Fridays, right before the volume really begins to edge higher or lower and trickles the market into raising those stops. Now, is where the algos struck this week. Look at that right here. See that level? I think that was either Friday or no, this was this beginning of this week. But you see right here, they brought in a bunch of stops and tried to trigger the market and do exactly what they did here. They weren't as successful because volume was higher, but this is what they were trying to do, exactly this. They were trying to trigger the buy stops into making the market seem like it's going higher and then sell off. We saw it here. We saw it right here. More importantly, they've been doing it a lot, not only on the S&P 500, but also on the bond market. Look at the bond market down here. They tried to trigger sell stops. Now, I'm actually kind of bearish on the market, and I think it's going to go lower. But remember, these algos try to trigger stops, and they're only concerned about the after effect that lasts about an hour to a day. So if they trigger a bunch of sell stops here, they would cover it right here. They couldn't do it. This market is really, really big, so the market bounced back higher. But be very, very careful of the bond market, not because of the algos, but because I think we may actually come a little lower than this. This seems like a little too much too soon, especially in light of what we're seeing with the economy. But this is another attempt right here. This is another attempt right here. Whenever you see these lows getting a little lower, that's typically algos trying to shake us out. Right here is another attempt, right there. So be very careful when you see these sudden moves or moves that are moving below the recent resistance or support area. Here's another one. They've been doing these kind of things, these kind of moves right here, this kind of move, this kind of move. It's very much done to trigger us out. Now, in the old days, when you would see a breakout like this would mean that there's buying pressure coming in. When you would see a sell pressure like that, it would usually mean a continuation of a trend. But right now, that's not the case. Right now, what you're seeing is the opposite. You're seeing a shakeout and the market move lower. You're seeing a shakeout, the market move higher. Same thing with the S&P. You get a little shakeout here, the market moves higher. You get a shakeout here, the market moves lower, just like right here. And it happened again right here. Now, it tends to happen less and less where we're in a trading range, and it happens a lot more when we're near crucial buy or sell levels, near support or resistance levels. So specifically keep your eye for algos Mondays and Fridays, early morning Mondays, late afternoon Fridays, when you see the market or the stock or the whatever asset you're looking at trying to break out. Because now, back in the day, 70% of the time, that meant that there's a breakout. Now it just means that algos are jumping in, and we got to be extra careful. So I wanted to make sure you're aware of this. So when you see a breakout now, give it a little more time. Give it an extra day. It's probably better because you want to see follow through. You don't want to just see a breakout lead into something like that and then the market turn around, because this is exactly what we were expecting. Now, let's talk about today's price action and what we can expect from the market in light of everything we've seen. So far, earnings have been, as you saw, they started out really, really strong on last Friday, and as they continued into this week, they seem to be fizzling out. So the expectation was negative 4.8%. Now the expectation is negative 5%. And as you can see here, the market's a little lower. Also, and I hate to say I told you so, but this is a monthly view of sectors. Now, if you look at it on a cumulative basis, technology and communications are still leading, right? Right. But look at them on a monthly basis. Look where technology and consumer discretionary is. I hate to say I told you so, but remember, it all starts out with a 1 month, then it goes to the 3 month, then it goes into the 6 month, and then it ends up on the cumulative. But over the last month, technology and consumer discretionary were literally second to the last spot, only behind real estate. So if you think that there's a lot of market cap coming into technology or consumer discretionary or even communication services, which was up here, let me just take you a week back. Communication services was number 1. This is April 13th. Technology was number 2, right? And consumer discretionary was in the middle. That's April 13th. That's a week ago. Now look at it today. Technology, consumer discretionary, communication services. Who's been telling you this for about 2 weeks now? Also, momentum levels. Let's look at momentum levels. You might or may not remember, but consumer discretionary was over 100. That's right, it was over 100. Not over 100, right at 100. Let's look at it now. See that? It's coming down. Look at that. And over a period, look at that. Coming down, right? And it looks like it's going to come down more. That's consumer discretionary from 100 to 66. How about infotech? Oh boy, you're going to love this one. Do you remember? It wasn't that long ago. It was less than 2 weeks ago. Or yeah, it was about 2 weeks ago, 2.5 weeks ago. Look at where we're at now, from 100 all the way to 39. You can watch my videos where I talk about this very, very, very extensively. And where's communication services? They all fell apart. Look at that. From 95 all the way to 50. So you got to watch these momentum levels, these short-term momentum levels. They're really, really good, especially the 20-day. It gives you a good ebb and flow of where we are. The 50-day is good too, but I like the 20-day for the short-term reactions. Soon, infotech is going to be oversold, but momentum levels on tech is not holding up right now. I think another sector that's going to bite the dust pretty soon is going to be utilities, and I think the only reason it's holding still up is because we haven't had earnings. So I think utilities is due for a little, and it can hold here for a while. It can hold here for up to 2 months, but we're really getting up there on utilities, and let me show you where else we're getting up there. We were up there on energies. Energies is starting to cool off too. Look at that. Remember, we were at 100. Now we're at 69. So be really, 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 really careful. And one more, healthcare. Oh yeah, I didn't forget about you, healthcare. Just want to show you the levels. And if you watch my videos, you remember right here, it was on the 13th. It was a week ago, and I said healthcare needs to cool off. Well, look at where we're at right now. We went from 100 to 60. I wouldn't be touching these till they're oversold. And be really, really cautious. Now, you could have a nice pullback, but be really, really careful. Momentum levels are coming down with earnings. And today, you've got earnings on Autolive, Freeport McMoran, HCA, Procter Gamble, and Schlumberger, SLB. Yesterday, oh boy, yesterday we had AT&T. You had Blackstone, CSX, DHI. You had a lot of earnings come out. You had Knight-Swift, you had Nokia, you had Nucor, you had Rite Aid, Seagate. Ooh, a lot of earnings came out. And so far, the numbers are not as good. Matter of fact, let's talk a little bit about this and kind of give you a little summary of what to expect. But as you could see, momentum levels are coming off. And I warned you ahead of time when the market was rallying that a lot of algos were coming in and the market was going to go down, and it did exactly that. If you don't believe me, just look at my videos from a few weeks ago. So now, 3 major U.S. benchmark indices finished the regular session in the red as investors assessed a mixed slate of corporate earnings while parsing through federal economic data. Tesla, ooh, ouch, what a stinker. 9%, vehicle posted weaker than expected results, put Nasdaq 100 into negative territory. I told you to watch that Tesla. AT&T plunged more than 10%. That's crazy, right? I mean, AT&T was top percent loser on the benchmark, and wireless care reported weaker than expected free cash flow. That's terrible. I mean, a utility stock. American Express fell 1%, but we saw good news from Lam Research, which prompted Micron higher and allowed us to take profits in Codebreaker on it yesterday. Labor Department rose benefits, employment benefits rose state unemployment benefits rose 5,000. It's now at 245. It was holding steady at about 200, 220, but now it's higher. Philly Fed Business Survey unexpectedly fell as well. So things are not looking as pretty as we think. And now look at what the Fed is saying, by the way. Oh, God bless that squirrely Powell. He's just gonna keep saying the same thing and hoping we believe it. But look at what the others are saying. Cleveland Fed President Mester Thursday signaled support for another interest rate hike while flagging the need to watch how banks pull back on lending due to the recent stress. Well, how about the economic data, Mester? How about that? It's not looking all that great. Demand is still outpacing supply in both product and labor market. Inflation remains too high. That doesn't sound rosy. Also, Philadelphia, Fed Patrick Harker warned that some additional tightening may be needed to ensure the policy is restricted enough to support both pillars of our dual mandate. I don't know what the hell he's talking about, but I could tell you, interest rates need to go higher because we still have inflationary pressure. Dallas Fed President Logan and Bowman said inflation remained too high and that reducing it was essential. Notice nobody's talking about capping it. So now there's an 85% chance of a 25 basis point rate hike. That's the highest we've seen. It comes out in about 2 weeks, actually exactly 2 weeks from now. So we'll see if this number fluctuates. But if this number stays where it is, and I think it will, or goes higher, that means we're not going to see much of a jump or a move from the Fed impact because it'll already be priced in. Today you've got Procter & Gamble, you've got HCA, and Schlumberger. Oh my. Now we're expecting 5% year-to-year decline. It was 4.8% yesterday. So things are just not looking all that crazy. And we're going to see a speech by Lisa Cook for more clues on the path of interest rates, where I'm going to predict she's going to say, well, what we're doing is working, but we need more we need more interest rate hikes to cool the inflationary pressure, and we'll eventually see what's going to happen. But I'm going to tell you right now, they're going to raise rates. It's almost a guaranteed certainty, especially with earnings being so crappy. Europe was up a little bit as investors digested a slew of important regional economic data and more corporate earnings, which is really good. China Shanghai today closed lower, weighted by artificial intelligence and tech stocks, as concern over a mixed economic recovery in the country kept market sentiment subdued. AI and information tech stocks were one of the biggest drags on the market, which means we have to watch tech here too. Japan closed slightly lower after data showed core inflation remained sticky. At the same time, a preliminary reading on Friday showed that the Japanese manufacturing activity contracted at the slowest pace in 6 months in April, while the service sector stayed strong. Now remember, they have a new prime minister, and this guy is an MIT grad who's very focused on economy, not theories like the old guy. So I think they're going to be raising rates, and the yen should be moving higher on that. Now today, I'm expecting the market, it's been down for 3 days. I think we'll get a little bit of a reprieve. I don't think we're going to get a major sell-off also because it's Friday. And I think most of the downside for the time being is priced in, and there's no major earnings today like there was yesterday. So today the market may cool off and just kind of stay choppy. In terms of the Nasdaq, let me just kind of show you. Ooh, look at that. Doesn't look great at all. Nasdaq looks like it's at the 20-day moving average. Typically, we see a bounce at the 200-day moving average, and we may just stay a little choppy, especially without a lot of tech earnings today. So don't expect a major sell-off. I don't think it's going to happen. Also, because it's Friday, and markets tend to be very choppy on Friday, and they tend to lose directional bias. But usually, markets are higher beginning of the week, lower second half of the week. But in this case, markets were lower first half of the week. So I think today's going to be more of a choppy day, kind of a consolidation day without a lot of trading action. If you look at semiconductors, which used to lead the market higher, they're not looking all that great, and they're sitting at a descending triangle. If this thing breaks, or if algos step in, that's why I'm talking about this, because it's Friday, and algos may step in. So if you see a little bit of a nibble here, wait for a confirmation, because if this thing goes, it can go lower. But right now, I'm not seeing it, and with good news coming out of Lam Research yesterday, we may get a reprieve. But I'm not a big fan of these descending triangles. But in this case, we may get a few more choppy days before breaking down. Also, when we're breaking down, watch out for this. Look at that. Trips us, makes us think we're going higher, and boom, we go lower. It happens all the time nowadays. Back in the day, it used to be like this. You used to see lows like that. They used to just click right on there, but now things have changed. Otherwise, I'm not expecting too much volatility, especially in light of the fact that earnings are selling off, unless the reports today are really negative, and I'm not seeing that at all. I'm seeing more of a choppy market. So I think we're going to open lower and kind of drift as the day continues, give us a little bit of a reprieve, and then we can position ourselves for Monday better. Now, before I let you go, folks, AI stocks have been breaking out over the past week. Well, they've been breaking down in China, but here they've been breaking out. Lance Ippolito has seen a surge in volume like he's never seen before, all flagged by his master indicator. That's why Lens just held an emergency training session to show everyone how his master indicator works. He also shared a handful of tickers and trade ideas that he's watching, and even scanned for new opportunities. Click the link below to watch Lance's free presentation. Followed the link. Check it out now. You guys are going to absolutely love it. And I'll talk to you later. Have a great weekend. Remember, like these videos, subscribe to this channel. And if you're in the YouTube, go to Wealth Press. That's where you'll find the Telegram channel where you can subscribe. You'll see pictures of my pets, my family, me, free trades. Did I say free trades? Yes, free trades sometimes, and some fun stuff, and you'll get your alerts early. So sign up now. Go to our YouTube Wealth Press channel, like, subscribe, and have a great weekend. Bye, guys. You can always send me an email, support@marketgeeks.com. Bye.